morning, everybody. It's Thursday, January 18th. And this is the AgYield War Room, Dan Dempsey, and I'll be moderating today's session. As always, if you've got any questions or comments or want to chime in on anything we're talking about, please feel free to drop us a line in the chat area, and we'll be sure to get to that during the show. Real quickly here, overnight markets had March corn down a half at 441 3/4. March soybeans were up a quarter, 1206, and March Chicago wheat was down 4.5 at 578. Good morning, fellas. Just as we were visiting here this morning, we continue to discuss the market makeup here. Interesting time of year. We've gotten through the USDA report. We continue to see relationship trades that are taking place between these different commodities, and really the biggest thing is managed money feels like it's sort of dictating the narrative here with, very little news on a day-to-day basis. We're not, by most accounts, not selling much. We've got no announcements here again today. So just an interesting market makeup, I guess, for the end of January going into, what could be a pretty exciting spring with the acreage discussions we're going to start talking about.
Yeah, I'd say, Dan, when there's not a whole lot of news, but we're obviously market setup has been believed to be that producers have had a lot of grain to sell, right? They had a high cash flow last year, and that kind of set up the stage for ability to kind of hold off on making sales. And so it is kind of widely believed that there's still a pretty big overhang of corn and maybe even soybeans that wants to be sold going into the new year. And obviously markets are not ideal compared to where they were a year ago from a price standpoint. But we have noticed for the last 6 weeks, funds have just been piling into shorts, both on the corn side. They're short well over 1 billion bushels of corn on net right now. And they've sold over 800 million bushels of beans equivalent over the last 6 weeks through the products and through beans. And that, that's to get them out of their length, but they appear to be going into a short position. So they have momentum on their side right now. And you think about levered markets, and, we're not huge technicians, but we think about what margin calls do to people. It gets them out of positions, right? It's hard to hold a position that's constantly, causing a margin call. So that momentum, I think, is probably impacting, the market negatively, as every day you're seeing some more longs capitulate as the pain trade continues for them.
Yeah, and I'd add to that, Dustin, you brought up some good points. When you trade, one of the downsides of a farmer or somebody holding physical grain is there's no margin calls, right? So you can have huge unrealized losses, by holding onto a physical commodity, but you're not forced out. If you were to take the equivalent and take a long position on the board of trade in a hedging account, and you had to fund that every day corn was down 10, you had to send in that money, you get out a lot quicker. So sometimes I think these markets have these long tails, and they're dramatic because it takes longer for the producer to realize the loss. And I think it's being sped up this year with interest rate payments, getting to the new year, there's cash flow needs. So those are the things that generally, I think force some physical grain to move. And the funds they've been right. They've been making money, they're earning the carry, so they have no incentive to stop selling. Right. So, that's the painful part of these markets, is you just don't know, until, hate to say it, but the farmer's got a bad trade on. There's a lot of unpriced bushels, the market sniffed it out. And so, it's just going to keep doing this until you've, got the last person that needs to sell, needs to move physical. And it's just so tough to know when that is. It could be today. It could be, could be a month from now, it could be months from now. So that's, Dustin, just to that point, I think that is one of the downsides of just owning a physical commodity, where you just really don't see the losses. It's easier to kind of ignore it, until you need the money or need a loan renewal or, some sort of an event that makes you, really sit down and figure out how much cash you need. And I think that's the phase we're in right now. And $1 million question is how long that lasts.
Yeah, no, I want to kind of get even just a little bit more technical to that idea. Is that, let's say normally you'd have a number of producers that would be spot selling on a January delivery. post New Year, cash flow needs to be raised again. Operating notes need to be paid down and off, especially at these interest rates. And so a grower goes to deliver, and they're looking in a mid 450s or even lower. Right now we're 440 on the nearby contract, and saying, I really don't want to sell that when I had higher prices over the last year. So a lot of producers, we believe right now, are opting to deliver on basis only contracts, which we've seen over through the course of harvest as well. And when we finally we do against a basis only contract out of the bin, let's say right now it's long in the bin and there's no position associated to it. It gets delivered to the delivery point on a basis only, and that delivery point gets to use it. Well, the way that position is still carried is that delivery point enters a long March futures contract on behalf of the grower until the grower is ready to sell that contract. That's why when you get to closer to first notice day, those 2 weeks prior to that, usually that delivery point reaches out to the grower and says, hey, we've still got this basis only contract. Do you want to roll it out to the May contract, or do you want to sell that contract? The problem with that is all of those market participants, if this is what's happening in mass right now, all of those market participants are getting that same phone call within a 2-week period, instead of an orderly flow of spot sales through that time frame. So if we have a disproportionately large amount of basis only contracts, that sets up the stage that there's a ton of long March future contracts on retail producer ownership that need to be moved in a very short period of time. So my guess is that we could see that manifest again in late Feb, just like we saw in the September and the December contracts leading into their corresponding first notice days. And another cue to this, again, getting a bit technical here, is since the first of the year, we've actually seen the March, May soybean or corn spread narrow up. It's actually reduced its carry slightly, but that would make sense in my mind that if funds are the ones that are holding the short position, not your producer merchant that we typically see at this time of year, if the funds are short 1.2 billion bushels on the exchange and they're stacked up their shorts all the way out through March, May, July, Sep, Dec, but we're getting all these producer longs coming in on the March, we would see spread narrowing March, May, right? So it makes sense anecdotally from what we're seeing that might be the setup, which is very concerning to us as we get into the last half of Feb of what happens at that point. Hopefully see some spikes in between now and then to kind of clean up this position. But I think fundamentally something's got to change to see that. Yeah,
to your point, I mean, it's really a loan, right? It's a loan for the farmer to give their physical up so the end user can use it, right? So they're getting roughly 60% of the value, so that keeps their cash flow where they need for the short term. But to your point, there's still a physical long, through the board of trade that's re-entered. So the net result is really just getting a loan, to hold that long. So, and that's, I think the other interesting thing there is, really new crop corn and even Dec 24, Dec 25, both new crops have kind of helped lead the way down. So I think there's a couple things going on here where I think you're seeing that in the nearby contracts, for cash flow needs, but you're also seeing some just outright selling in new crop as producers are going in talking to their lender. Their lenders are nervous. They're nervous about what those break evens look like and about, getting some monies for prepays and things like that for New Year or for the new crop, where you're seeing a lot of pressure in the back end. So I personally think that those signs are kind of that you're getting close, whether, like I said, whether that's a day, a week, 2 months, but I think you're kind of getting into that final phase of, let's say, panic a little bit, where kind of got used to good margins for several years now. And the first time it's been tough since 2020, where you're kind of getting a little bit of panic here, especially with higher, input costs than we've been used to. So I think there's a couple different dynamics. I don't think there's one reason or one boogeyman that we can point to why these markets suck so bad. I think there's a few things at play here, from what I see.
In some of the years, I had this question posed yesterday, but some of these years where you've come off of, we'll call it good markets, or you've broke into needing to find demand or whatever the story is. But what, in your guys's estimation, I mean, how long is that tail on the input side for costs? I mean, we talked a little bit yesterday offline just about, is there just a kind of a restructuring of cost that has to happen across our whole industry to get this thing back in line, because, you know, by all estimations, a lot of farmers are kind of out of line on that part, you know, in terms of their cost matching up with where we're at for the product that, or the cost of the product we're given.
Yeah, we talk a lot about sticky cost reduction. And, you know, I think university data still shows that, like, especially FarmDoc, they've got, you know, numbers that are still elevated, albeit less than last year, because nitrogen costs have come down. But, you know, they're still elevated. We know land rents have been sticky. We've seen a lot of, you know, really high end land sales still too. So land prices have not reset in, you know, the, you know, in this industry like they have in the commercial real estate industry. So yeah, it did in 2014 eventually, right? But 2014 was largely considered an equity losing year for the average grower, because we came out of 12 with really good prices. We had a big break into 2013, right? And but at least insurance levels were still set high enough early in 2013. And then we get to 2014, and then even though we had a really good production year, price trumped production, and we fell down to levels we hadn't seen in a long time prior to the drought years, prior to 2011, really. And it was an equity losing year, and then costs started to eventually come down in 15 and 16, and you know, we had to make $4 corn work again by the time that we got to 2015, 2016, as producers. So mean reversion is what that's called. And if you look at a monthly chart, it certainly appears that we're on a mean reversion course right now. Looking at that, the one difference that's the big question for us in the industry is, what impact does all these extra dollars in the market do for commodity prices? Is it, you know, gold is now, you know, comfortably above $2,000 an ounce. You know, I didn't think there's a question that inflation has had a play on cost. Everyone's feeling that right now. Is the inflation also not going to reset the benchmark of what a minimum corn and bean price is? Maybe it doesn't. Maybe we just keep getting really, really good at producing larger crops around the globe, and South America is able to undercut us on cost, and they can fulfill that void. And the job of the market is to take acres out of the U.S. I don't know. That's the $1 million question.
Well, you know, just to add to that point, I mean, this is not the first time we've seen this kind of a cycle.
Mm-hmm.
You know, and I think, you know, when times are good, when margins are high, and it feels like, you know, nothing's going to change, people spend money, whether it's new pickup trucks every year, trading in the tractor every year. You know, if farmers are smart, they will go and cut back on all those things, right? So it doesn't just have to be land. I think land's going to be sticky just because there's a lot of different people that like to buy U.S. farmland for different reasons, investment purposes or whatever. But first, it's things like rent. You got to find someone that's not willing to pay that high of a rent number, right? So that's naturally got to come down, or that, you know, they cut back on whatever they can, like, you know, having the tractor for an extra year before they trade it in. You know, all those little things that add up just has to happen in these environments to lower that cost. And some things are out of your control. And, you know, it's a good conversation we had yesterday afternoon, actually, talking about the narrative will be that farmers will cut back dramatically on inputs, and that'll affect yields. And that could be true in some cases, maybe some fringe areas or areas like that. In my experience, and you guys can add in here, but people, when we're low prices, tend to try to get more bushels. As counterintuitive as that might sound, you know, unless the weather is really adverse or it's just throwing money away. Mm-hmm. Farmers will generally try to justify, you know, the new price environment with, I just need to get, you know, 270 bushel corn to make it work.
Right.
Yeah, 2014, right? 2016.
That's conversations we heard all through that time frame.
Yeah. Throw everything at it. That's exactly right.
So
no, very good. We got a couple minutes here. Ryland, what do you got on the livestock sector?
Well, not too much, Dan. Pretty quiet in the cattle market yesterday. Beef prices have been just exploding back higher. So I think that was just, you know, that's been expected just because of the production cuts we saw because of the weather. Really no cash trade yet, but Packers were bidding up in the north, like 175. So the expectation that cash is going to get pushed higher, at least in the north. So we'll see how they react in the south. Asking prices are around that same level in Texas and Kansas. So looking for a little bit steady to firm trade there. Otherwise, just kind of looking for some kind of news other than just the day to day. But yeah, China imports came out and really were nothing special on the meat side of things. As expected, pork imports were down about 54.3% from last year. So it just kind of goes to show that they don't need anything right now. They're going through their liquidation, and beef was just down slightly, still holding 240,000 tons. So for year over year, it's down slightly. So, I mean, not a big change there. So overall, I would say that, we're kind of coming into this time frame where we're looking past this winter and into the spring now. So I think that's going to be the focus. But as of right now, it just kind of feels like we're kind of in this grind higher, and trend is a little bit more on the positive side in the live cattle and the feeders. Feeders obviously love this kind of break in corn here. So it feels like those guys may be loading up to a pretty large degree. So we'll see if that changes much on the feeder price side of things, but could take a while.
Very good. Appreciate that, Rye. Just came into the open here, fellas. We got March corn down 2 1/4 at 440. March soybeans are down 1 1/4. 1204.5 is the last, and March Chicago wheat is down 7 1/4, 575 1/4. Couple of administrative pieces here before we wrap. Export sales will be out tomorrow morning, 7:30 Central. They were delayed a day due to Martin Luther King holiday on Monday. We also will be having a premium content show on January 29th at 2 o'clock Central. There will be some pre-registration that we will have available. We will have John Wenzel from StoneX. He is the director of energy and fuel markets. He's going to have a nice discussion on some trends and things to look forward to as we go into the spring. So keep that on your calendar. And as always, we are streaming live every day on X, Facebook Live, and YouTube Live, 8:15 Central Standard Time every day that the markets are open. Appreciate the conversation here this morning, guys. It was really good. Good stuff. And look forward to talking to everybody tomorrow, 8:15 Central. Have a good day.
Thanks, Jan.
Yep.